Welcome back, everyone. This is a brief update on news from the oil market. Russian officials made it clear through their statements on Monday that Russia could be aiming towards raising oil output when it meets with OPEC in June. The oil market conditions have seemingly improved enough with failing stockpiles, and the target of balancing the oil market may have been achieved at a satisfying level for the time being. Analysts point out that the scenario of the OPEC Plus group to remove production cuts and increase supply is not far-fetched. The cartel could be now working towards balancing the oil market, but in the opposite direction, as the production cuts are not a method to be used non-stop. If market circumstances require oil production to be expanded, then the OPEC Plus group could be willing to chip in and do its part, according to Kirill Dmitriev, head of Russian Sovereign Wealth Fund RDIF. Russian President Vladimir Putin also commented on the matter, saying they are not supporters of uncontrollable oil price rises. Supply in the oil markets has been kept under control despite booming U.S. production, while at the same time Washington imposed new sanctions on Iran and Venezuela, reducing their output and exports. Commodity specialists argue that the U.S. has managed to grab Iran and Venezuela's market share, and the market could now be turning attention towards what new sanctions Washington could impose on Iran in early May. Furthermore, concrete data confirmed U.S. crude cargoes aimed for Europe decreased in March and will remain low according to trade sources and data from Refinitiv Aecon. Tankers with approximately 265,000 barrels per day are expected to arrive at European ports this month, much lower than the 719,000 barrels per day that arrived in March. The considerable drop forecasted could be indicative of an alternative sources of oil from European companies or refineries, and should be taken into account given the recent surge of American production levels. Yesterday, EIA also released its updated forecast for the remaining 2019 moving to 2020. According to the EIA's U.S. crude oil production is expected to rise by 1.43 million barrels per day in 2019 and to average 12.39 million barrels per day. Furthermore, estimates were made on future demand, with EIA indicating demand in the US will remain unchanged for 2019, while an increase is possible for 2020 with a rise of 250,000 barrels per day. As per our conclusion, US API weekly crude oil stock released last night provided a surplus of 4.1 million barrels, which may have removed some support from oil prices' latest surges. Oil analysts and traders now turn their attention to Washington, where they will decide whether to enact new sanctions on Iran or cut waivers provided to countries still importing Iranian oil. However, our opinion is that the US may keep its harsh stance towards Iran. Please note today that EIA weekly stocks will be released at 17:30 GMT plus 3 and could increase volatility for oil prices significantly. For more in-depth investigation, please refer to our written report, which also includes technical analysis. For more information and trading ideas, you can visit our webpage, follow us on Twitter, like us on Facebook, or subscribe to our YouTube channel. This is Angelos Zitis from IronFX, wishing you solid trading.